one of the most common things people ask, I'm thinking about buying a house, what should I do next? I would say get a hold of the bank you deal with, whoever you do your checking with, or maybe a local credit union. Talk with your parents, see who they have their mortgage with, or call me. I have some lenders I deal with very closely. What you want to do is get pre-approved. Talk to them. They're going to tell you what's important, what's not important. They're gonna ask you a couple questions. They're gonna run and get your credit score. You need to have typically a 600, 620, 640 is preferred. The better the rate you're gonna get. And they're gonna ask you how long you've been working at your current job. You need 2 years of employment of the same job, or if maybe it's not the same company, it has to be a similar job. They want 2 years of history on that. And then they're also, you need to have the available funds to make it through a transaction. It's going to cost you $1,000 up front for hand money when you make an offer on a home. That comes off the price of the house. If you offer $100,000 for a house and you put $1,000 hand money down, you now only owe $99,000. Typical loans, if you did an FHA, it's going to require 3.5% down of your own money. So 3.5% of $100,000 is $3,500. Definitely have that. And then you have additional closing costs, some lender fees, taxes, insurance. That all has to do with depending upon what house, where it's located. There are rural loans. It's a USDA. It's a rural loan where that's 100% financing. So when I said 3.5% down, this is 0% down. They finance $100,000. You still typically put some hand money down. You still put hand money down. You still have some closing costs. However, we can ask the seller to pay up to 6% of the closing costs. So you can get on $100,000, you can get $6,000 back from the seller towards your closing costs. Again, they may not even be that high. Then you can do conventional loans. 3% down, 5% down, 10%, 15%, 20%, all them different types of loans. And the reason for doing different ones, the interest rates are typically different, each and every one. FHA, USDA, conventional, all different interest rates. The better credits you have, the better interest rates you get. And then also PMI is the big variable in everybody's mortgage. It's what a lot of lenders don't even tell you when you call and get a quote for a price on a house. They don't even include PMI. Sometimes they'll play a little bit stupid. Oh yeah, well I didn't know what type of loan you were going to do, that type of thing. Different rates of PMI for each type of loan. FHA, USDA, conventional, all have different rates in the PMI. FHA, USDA are going to be a higher rate. Just a round number on an FHA PMI on 100,000 is going to be $80 to $100 a month, and that's allowing you to buy a home with only putting 3.5% down. You want to if you were going to do a 20% down conventional loan, there would be no PMI. So any home that you buy with not putting 20% down will require you to pay a PMI. It's called private mortgage insurance. So that's what we have for you today. If you have other questions, you want to get more in depth, you can give me a call. My phone number 724-712-6037, or get on my website, shoot me an email, nickpahomes.com. I appreciate it. Have a great day.